Good afternoon, everyone, and you're very welcome to our webinar, the Pillars of the Recovery for a Post-Pandemic Economy. I'm Michael Diviney, and I'm Executive Head of Thought Leadership at Chartered Accountants Ireland. We're actually celebrating the publication of a practical guide to examinership by Neil Hughes, FCA, and Hughes and his corporate recovery team at Baker Tilly, Ireland. According to the Central Bank of Ireland in a report in April of this year, 1 in 4 SMEs are going to fail as the Irish economy emerges from the effects of the COVID-19 pandemic and government supports start to be withdrawn. But does it need to be that way? Do so many businesses need to fail and so many livelihoods and jobs be lost? To address these questions and the best recovery mindsets and approaches to adopt, Neil Hughes will first present about the pillars of the post-pandemic business recovery. This will be followed by a panel discussion about corporate recovery options, including the new summary rescue process, as well as the broader issues for businesses on what to expect and how to manage as the economy emerges from the COVID-19 restrictions. We are very grateful to our expert panelists for joining us today. Desi Morrow, Director at Baker Tilly Ireland, who's Senior Manager in their Corporate Recovery team. Julie Murphy O'Connor, who's a Partner at Matheson and an Insolvency and Restructuring Lawyer. Adrian Cummins, CEO of the Restaurants Association of Ireland. Fergal O'Brien, Director of Lobbying and Influence at IBEC. Dee Moran, my colleague at Chartered Accountants Ireland, who's our professional accountancy leader. And of course, Neil Hughes, who's Managing Partner at Baker Tilly Ireland. After the panel discussion today at about 3 o'clock, we will open the webinar for your questions to the panel. Questions can be general or asked of a specific panel member. In asking a question, I'd ask you to please use the Q&A feature on Zoom. Now, by way of introduction to Neil's presentation on the pillars of post-pandemic business recovery, I can quote from a prescient view he shared with the Irish Independent earlier this year. It's not about surviving the recession of 2020, it's about surviving the recovery of 2021. Neil, over to you. Thank you.
Michael, thank you so much. And welcome everyone. And thank you so much to everyone in Chartered Accountants Ireland for hosting this webinar at what is a critical time for the Irish economy, a turning point in so many ways, as we'll be talking about now in the coming minutes, because the reopening is now starting to accelerate. And I suppose arguably you could say the timing of this webinar, Michael, is quite, I suppose, appropriate, just where we are in this current cycle. But we're really looking forward to the next hour or so, because we want to go through what are the key factors that we believe are going to be so important now for the sectors in the Irish economy that have been worst affected by the pandemic, to give them the best possible chance to bounce back strongly. And we'd love to be doing this in person, as we were saying just before the webinar started, because what a turnout we have today. So it's absolutely fantastic to have friends and colleagues from all over Ireland joining us. So thank you all so much for joining us. And I suppose in advance of the panel discussion, which I'm really looking forward to now in a few minutes, we're going to try and set the scene now for everyone with this short presentation. It's just 8 slides, but with the assistance of Desi, who is another examinership specialist from the team in Baker Tilly. We're going to look at what we think the key themes are that business owners are going to have to get right in order to bounce back strongly this summer. And as Michael said, we'd love if you have any comments, or if you have any comments for us at all, please feel free to join in as we go along with the chat box. So I will be touching in a while on a couple of the publications that we've brought to the market in conjunction with Chartered Accountants Ireland in the past few years, the 7 C's here and the practical guide most recently. And Michael, while I have you here in front of an audience, maybe I could say thank you again to everybody in the team at Chartered Accountants Ireland for the support in finally getting this labour of love for the Baker Tilly restructuring team finalised. I think it's fair to say it became more and more acute as the pandemic intensified late last year, and the need to get it finished became more and more acute. But we're absolutely delighted with how you and the team have presented the final book. So thank you so much for that. And also, can I quickly say thank you to everybody in the Baker Tilly team for the contributions. This was a team effort here, and something we're quite proud of. But I wanted to start today with the recovery mindset, hugely important issue. And I have been fortunate over the past 6 years to act as Honorary Secretary and Director of National Mental Health Charity, Mental Health Ireland. And what I learned from that work was that the type of recovery approach that is needed for an individual that may be suffering a crisis, a service user, for example, it has got many similarities with a business that's in crisis, or indeed by extension, business owners that find themselves in crisis. And you can see some of the key issues here. Staying connected, obviously, a hugely important issue. That's been difficult for everybody in the country over the last year. But it's very difficult for a business owner to stay positive if they've been locked down or if they've been closed for over a year. And it's difficult to find the resilience that's needed to bounce back. And it's really hard for anybody to fully believe that they're in control of what is happening. And I think that's especially the case for example, for some of Adrian's members in Restaurants Association of Ireland, where they have suffered restrictions, the opening and the closing again, the issues that brings in terms of the team, in terms of stock in the premises, the outdoor-indoor debate. And I'm sure we can explore a little bit about this now a bit later on. But that lack of control has been a hugely important issue for many business owners. The real belief that they're influencing positively the outcome of what is happening to them. And I think there are a lot of positives out there. And I'm sure Fergal is going to be sharing this with us now shortly in terms of the insight that IBEC has and the Fergal specifically will have. So I'm looking forward to that, I must say, Fergal, when we get to that point. But we strongly believe that the hope that is required for businesses, it has to be based not on high level macro issues. It has to be based on practical positivity, a series of practical steps that builds resilience, and that in turn then leads to a feeling from a business owner of being in control. And those practical steps, they formed the basis of the book that we produced in 2010, The 7 C's of Business Recovery. And that, the purpose of that, Michael, as you recall, was to try and put business owners back in control, even when they're in a crisis, even when they're looking at restructuring options. And just to, I suppose, touch on what, again, I suppose to refresh on what those issues were. First of all, counsel, taking advice, not just internally in terms of the board a business may have or a company may have, but also external advice, expert financial and legal advice. The issue then we spoke about the honest communication that's needed with creditors, for example, and the necessity to properly legally document any agreements or variations, for example, in relation to rents, which is such an important issue. And what we have found is that you would be amazed at the goodwill that you will get back from the key stakeholders and key creditors if you just level with them in terms of how the business is actually doing. And in the last 12 months, because of the fact that the pandemic is nobody's fault specifically, I think this again has been reinforced in many ways, that transparency, that openness, that there are dividends that can be got from adopting that sort of policy. I think we've got an opportunity now, actually, because of the fact that the pandemic is a once in a century event, there is an opportunity to reset from an economic perspective, the transparency and the openness in the Irish economy, which is going to, I think, in the long term, it could bring significant benefits, something maybe in the US has been there for many years. But moving on then, getting the team back together, the cooperation, which I spoke about, that's so important for a high-performing team. And again, I know it's a hugely important issue in pubs and restaurants, and indeed even in retail as they reopen this week, is making sure that the team is back together. All of that kind of planning stage leads to clarity. And clarity in relation to where we are now is a new business plan. A new business plan that takes into account the fact that we cannot continue to do things as normal, whether we work in an office looking at hybrid working models, or whether in fact the products and services that the business may be built their success on over many years just may not be there anymore. And the business model has to be flexible. We have to have a number of different scenarios, and that the clarity that is going to come from that will lead to proper decision making in terms of what the options are there for a business. We spoke then about cash. We're going to look shortly now in a second just at some of the alternative sources of finance that are out there, and that it's important for, I suppose, chartered accountants as advisors to be aware of, so that we can actually give those options, those refinancing options to our clients. And also then the government assistance. A lot of this now is going to be pared back. I'd be interested in the panel's view about whether or not some of those supports should remain even a little longer perhaps, or is it economically feasible to do that? But our advice, I guess, is to make sure you take absolutely everything on offer. And I'm going to look at a couple of those key supports now just in a second. And that leads on then to the cost base, and people will be familiar with this famous quote about not allowing a good crisis go to waste. I think everybody has learned about efficiency in the last 12 months and about the savings in the P&L, which can come from a line-by-line approach to costs. The issue for us, I suppose, of what we're recommending is now to try and make sure that those reductions are permanent, and that the waste that may have been there in a lot of business models is actually cut out permanently. It's important, obviously, that the knife doesn't go through the fat of a business and right into the muscle. The business still needs to be able to perform. But I think there is an important lesson to be learned from the last 12 months that perhaps we can be a more efficient economy as we move forward. The 7C, your customers, focusing on outstanding customer service. There's a huge amount of your customers have not crossed the door over the past 12 months. And there's an opportunity now just to really give them a welcome, so that they are struck by the welcome when they walk in. And they're really glad that they came in the door. As they're walking out, they're saying that was a really, really strong experience. I think it's going to be critical. Price will just get you into the game, but service wins the game ultimately. And customer service, I think, a hugely important issue as we move forward. I mentioned some of those support systems here. This is a really busy slide. I have no intention of going through it. And I think, Michael, we mentioned earlier that the slides will be available, I think, for all of the delegates here today. So we've been using this. We assembled it as the pandemic unfolded as a kind of a checklist for clients, just to make sure that everything that's on offer was being taken advantage of and was being availed of. I just want to, I suppose, bring your attention to one particular issue, and that's in relation to the credit guarantee scheme, the SBCI funding that's available. I think there was about 2 billion of this that was made available by government, guaranteed by the state, and only I think 350 million has actually been drawn down or utilised. Now when we saw this, we just saw this as a golden opportunity to try and put in place the right funding model for businesses, not based on the old style of personal guarantees, but based instead on the fact that the state is recognising the importance of the tens of thousands of SMEs in the economy, the contribution that they make, and making a very tangible support measure available, whereby the state would actually step in and give a form of guarantee to the bank. We know that there are certain clients of ours who are taking the opportunity to take, for example, a personally guaranteed overdraft and replace it, term that out with state guaranteed funding by way of a refinance. There are some rules around that, but there is, we think, a golden opportunity to try and right size the funding model for your business, something to keep in mind. As we said earlier, some of these models are now, or the support systems, they are being withdrawn. And obviously the CRSS being the obvious one now in the coming weeks. So that is going to be an important issue as businesses have to stand up again. It's only then that we're going to see which ones are capable of staying standing, or in fact are some going to fall over, and they may be in need of some form of restructuring. The funding landscape, and again, another busy slide. This is the Intertrade Ireland summary of the funding options that are out there. And I want to just look over on the right-hand side, if that's okay, just at some of these alternative providers, because you can see even the traditional funders on the left, Ulster Bank, are going to be falling off that list shortly. We've question marks over KBC, which is not on that list over there. On the right-hand side, the alternatives. 10 years ago, a lot of these providers were not in the market. There is a change going on in how capital flows around the economy. There's a change going on about how capital is deployed in the economy. And as chartered accountants, we have to be alive to that. We have to keep track of who those options are for our clients. And some of them are, there are names which they may not be familiar to our clients. They may not know they exist, but especially some of these working capital providers are just going to be so critical, because it's a lack of cash that ultimately leads a business to fail and to perhaps need some of the restructuring options that we're going to see now on the next slide, or our final slide. And I think a knowledge, as advisors, a knowledge of the options that are out there, as you can see on the far right, I think that's just going to be a hugely important issue. These new names, which we're not familiar with yet, but we have to embrace that as advisors and say, this is the future, until we see some more pillar banks coming into the economy. And we seem to be left with now perhaps, maybe 2.5 hopefully shortly 3, if permanent TSB strengthens and grows, we could have maybe a 3-legged stool rather than a 2.5-legged stool going forward in terms of pillar banking in Ireland. So it's something we have to be aware of. And I'm going to turn now then just to the restructuring options that are out there. Just a quick comment on each of them, and I think Desi is going to join in maybe in terms of the new summary rescue process, which we'll look at in a second. But those options include, for example, refinancing. And refinancing, the way typically this will work, there's usually a standstill arrangement that's entered into with the financial institution that's involved with the business, and then followed by some sort of a deal. If the loan has been sold, there's usually an opportunity for a discount. And for example, anything from say 3%, something I saw a couple of weeks ago, a loan that's fully secured and is performing for an early settlement, to a 20% discount, for example, with a loan that we looked at a couple of weeks ago, again, in terms of a performing loan with a service provider. Goldman Sachs was behind the whole thing, but those sorts of substantial discounts represent an opportunity for SME businesses if they can get the finance they need to refinance and restructure. So there's opportunities there. The private equity phase in the economy always comes with a lot of fear initially, the first 2 to 3 years. And then slowly but surely, SME owners start to realize that, hang on a second, there's a very substantial saving I can get if I can arrange a refinance here. Looking at informal schemes then, and the reality is, as we all know, tens of thousands of businesses in the economy have been involved in informal restructuring over the past 12 months. Phased payment arrangements, holidays in relation to rent, moratoriums with the banks, deals with creditors, time to pay. This is the Irish economy for the last 12 months. That's what we've been dealing with, and that's going to continue. It's very likely that's going to continue as businesses struggle to stay on the right side, and that's just the reality of where we are at as an economy right now. I think this is a good opportunity. Desi, I might hand over to you, because the new summary rescue process, or SCARP now, I think as it's becoming known, we're starting to understand a little bit more of what that's all about. So Desi, maybe over to you just for a couple of minutes on the new process.
Thanks, Neil. So what we know about it at the minute is that government approval has been secured for the priority drafting of the bill, and it will amend certain aspects of the Companies Act 2014. It's designed for small and micro companies, and those companies would represent 98% of companies in Ireland, employing about 788,000 people, and obviously making the process accessible to those businesses most in need, and to represent a central cog in the Irish economy, is of vital importance at this time. It is commenced by resolution of directors rather than by application to court, and the benefit there, I suppose, is that it avoids upfront petitioning costs, for example, where there are no funds to pay wages. So that is a serious benefit. It's overseen and assisted by an insolvency practitioner who will be known as a process advisor. And the benefit here compared to an examinership is that the process advisor can commence immediately on passing of the resolution. And that's particularly important if the appointment is urgent. We would have seen cases, Neil, in the past where a company urgently requires to go into examinership. There's a requirement to put in place a lot of different papers and resolutions and petitions, independent expert reports, etc. And all of that takes time, and importantly takes some cost. And even when you get to that stage, the examiner may not be appointed on an interim basis. So you end up having this lacuna for about maybe 10 to 14 days where the company is under the protection of the court. There is no third-party examiner in place, and the examiner may not get to start his work until 10 or 14 days later. So I think that's helpful here as well for the prospects of the process being a success. It's concluded within a shorter period than examinership. So creditors are invited to vote, from what we know, on the rescue process by day 42 of the insolvency practitioner's appointment. That's likely to be quite an intense process in terms of securing investment and formulating proposals within this time frame. And many of the examinerships that we would see would stretch on for longer than that. It really looks tight if an existing facility is required to be restructured, or if new borrowings are required to be drawn down to pay for the cost of the process. And then the other factor that's not, you can't put numerics on it, but there are certain cases where a creditor who's really, really disgruntled, and for very, very valid reasons often, but they need time to see that this restructure is actually working. And that might take the form of payment on delivery or the likes. And for instance, in some construction company examinership cases, we would have seen creditors very much opposed at the start of the process, see that the construction company maybe has a lot of very valuable contracts to complete and wants to be part of those contracts and the income that they can earn from being a part of that. The process itself will be approved without the requirement for court appearance, provided that a majority in value of an impaired class vote in favour and that no creditor raises an objection to the plan within 21 days, the 21-day cooling off period. That's drawn, the voting itself there is drawn from a comparison from an examinership perspective, and it does provide for a cross-class cram down. So that's one impaired class can cram down the liabilities of other classes, even if those are dissenting creditors. The issue, I suppose, that we expect to see is that there is nothing at present, based on what we know, that will prevent creditors from objecting to this. And so we expect that there may be a requirement to go to court for a lot of the cases. And I think to use an Australian reference point, there's quite a similar process there in terms of a cooling off period, and very, very often that does require an application to court. So we'll have to watch that space and see what the bill looks like when drafted. But maybe something that might be helpful would be any frivolous objection by a creditor would result in costs being awarded against that party. The process intends that an outcome will be provided by day 70, which is shorter than an examinership. So again, this is welcome in the form of a quick turnaround. It does, however, point to an inference that you're really going to need to know how you're going to fund your way out of the process at the start, whereas in reality, very often many of the examinership cases that we would see and other firms would see is that there isn't a ready-made solution at the outset. So I think that certainly is the timing is a negative. You really need to have your ducks lined up in terms of funding, and if you have, I'm sure it'll be fine. I suppose the safeguard for creditors is that they can go to court to seek to force the company to seek court approval if they object to whatever the scheme is. And I suppose the biggest part that will come to it now is that at present, based on what we know, it seems that the state creditors may be excludable. And I think that's problematic on a number of grounds. One such ground is the prospects of having certainty. If the state creditors have discretion as to whether they choose to participate within the process or not, I think we'd want to know on what grounds will they make that decision. I think secondly, from the point of view of providing certainty for an investor, we need to know the liability now, or alternatively, we need to factor in the fact that those state creditors, for instance, the Revenue or the Department of Social Protection, need to be paid in full. And I might just bring you into that, Neil, right now, because I know you certainly had a view that most people who are looking at that will think that if I need to pay Revenue in full or Department of Social Protection in full as part of a summary rescue process or SCARP, I think very often they're going to choose examinership.
Yeah, exactly. And that might be, you're quite right. I think it could actually then render the process, even before it starts, just less attractive to SMEs. Because look, let's face it, the state creditors, they tend to be a common denominator in most insolvencies. So if they are immediately put off the new summary rescue process because they can't deal with maybe substantial revenue arrears or whatever they have there, it could just push those businesses back towards examinership anyway. And certainly in some of the earlier discussions we've been having now, that certainly seems to be the case. Desi, thanks a million for that quick summary, much appreciated. And just to finish up then with the last couple of options that exist then for businesses. The formal scheme, I won't dwell on it, so rarely used, but it is possible to go to court and keep control of the restructuring with a 75% high bar in terms of creditor support, and the lack of automatic court protection for businesses in this Section 450 formal scheme process means that it very, very rarely used. You'd only see it maybe a handful of times in the last 20, 30 years. So I won't dwell on it for that reason. And we're going to be talking, I think, quite a bit about examinership in our panel discussion now. So again, I won't dwell on this here, but examinership, it's Ireland's formal rescue process since 1990, designed to save viable enterprises and thereby save the jobs of the employees. It's saved over 15,000 jobs in the Irish economy in the past 10 years. Still underutilized, which is something I know we can explore now with the panel. As a lot of these restructuring options are, would only say 2% of businesses entering examinership compared to liquidation and receivership. And liquidation and receivership, that is the final option, which we're trying to avoid, I guess. The whole purpose of today's session is to look at other options other than a winding up and the necessity for a business owner to restart. So everything we're talking about today, even though I suppose inevitably there will be business owners find themselves in this position, but really what we're talking about today is to give hope and to give options to business owners to avoid the necessity to liquidate and restart. And hopefully, you know, with everything we're going to discuss now with the panel, we can try and expand on that and again give a bit of optimism and a bit of positivity to everybody that's joining us here in the webinar today. So thank you all very, very much. Michael, I might hand back to you just on that note.
Thank you, Neil. Yes, that was great. Thank you. That's a very enlightening and positive presentation, may I say. Okay, so we're going to start our panel discussion now. So the panel can turn on their cameras and reveal themselves. We'll start. Actually, the first question I'm going to ask is to Neil. Neil, you wrote recently in Accountants Ireland that, quote, historically at least, the use of formal corporate insolvency mechanisms to restructure struggling businesses has been viewed quite negatively by the Irish business community. And you mentioned there that only 2% of Irish companies that become insolvent go into examinership. So there's been a reluctant, slow uptake of examinership as a process to deal with insolvency. Why do you think this is, and what would improve rates for its adoption?
Yeah, it's a terrible shame, Michael. I agree with you. We wrote the book originally to try to remove some of that mystique that still surrounds examinership. You know, not a lot of people are actually really aware of what it involves. And that, by the way, is in amongst the advisor community in terms of, you know, accountants and lawyers in Ireland. Like, there are some specialists that you'll find, and, you know, we're being joined, for example, Julie and her firm and so on. There are specialists, but there's a lot of other firms just are not familiar with this whole world. But I think just in where we are in the economy currently, I think we have to, you know, it's an obligation for advisors to be familiar at the minute when you've got tens of thousands of businesses closed, when you've got the likes of Adrian's members who've been struggling so much in the last 12 months and are crying out for help. Examinership, it's such a robust tool. You know, when Cyprus entered its crisis in 2013, the Troika insisted that they bring in personal insolvency and a restructuring tool, a company restructuring tool, in return for the 10 billion bailout that they gave them. And they had 27 options in amongst the member states of the EU. And they chose examinership. And they copied it word for word into the Cypriot company code. So we have a tremendous opportunity now. We are lucky to have these tools available to us as advisors to be able to recommend them to our clients. And I think, as Judge Michael Quinn said in his very generous foreword to the book, there's an opportunity actually for Ireland to become a centre of excellence in terms of restructuring. I don't think it's any accident. For example, we saw Norwegian Air locating and you know, bringing their restructuring, the global restructuring, to Dublin. So I think those are some of the key issues there, Michael, in relation to that matter.
Do you think that, you know, we've discussed before, you think that there may be some psychological barriers to it? You know, there's a stigma around business failure potentially that.
Yeah, there's certainly,
you know,
there's a pride factor, Michael. There is a pride factor, and yeah. It's more in terms of male business owners than female business owners. Funny, because I've found that female directors tend to be a lot more practical about these things. But there is a pride factor there, certainly, and that has to be overcome. But again, I think there's an opportunity now, because the pandemic is nobody's fault. Do you know what I mean? Like, there's no blame. There's an opportunity for a kind of a no blame culture to emerge from the pandemic, I think, which could be really interesting in terms of the enlightened approach to making sure that a viable enterprise stays trading for the sake of getting everybody that wants a job in the economy back to work. So I think there is an opportunity there.
Yeah, and with the SCAR process coming in, that will potentially deal with the perception that examinership is quite expensive. We've discussed as well, the fact that the SCARP or the SRO, the summary rescue process, doesn't have to involve a court. And how do you think that is going to benefit small businesses?
Well, we found that examinership for small businesses is not expensive. Examinership for large businesses that get the headlines, maybe on the front page of the Irish Times, is expensive. But examinership for SMEs, I think, Desi, it's fair to say that our experience has not been terribly negative. It's certainly never been a barrier to anybody that we've spoken to. There are some companies that are micro companies possibly that simply don't apply. But no, I think it is welcome. If anything, that can be more streamlined. I totally agree with Desi what he said though about there is a double-edged sword about making something very, very quick, because things are very raw for creditors. And if you try and speed things up, there's time is needed for all of the stakeholders to buy into a business plan. So if you present something as a fait accompli, as a pre-pack SCAR process, I would see challenges ahead with that. And I'd be interested to see what the panel likewise and what their view would be on that matter.
Okay, I was going to ask Julie about a particular aspect of SCARP, and it's something I know that IBEC are interested in as well, as to see in the legislation that it would deal with what are called onerous contracts, for example, rental leases. Julie, have you any views on that and what the importance of that aspect of the SCARP process would be?
Yeah, thanks, Michael. I think that, well, look, with regard to onerous leases, the legislation is still at drafting stage, and we don't yet have all of the details as to how the process is going to deal with issues of onerous leases. But what we can certainly say is that in many cases, the greatest threat to insolvency faced by SMEs will be the burden of these leases where passing rent exceeds market rent. I think it could be especially the case in the aftermath of COVID-19 restrictions, where we might find that the market rents in some sectors in particular will fall below those, the rents that would have been agreed prior to the emergence of COVID-19. And, that if it happens, will place some businesses at a significant disadvantage when compared with new entrants in the same line of business, and also as against companies that might have used the examinership process in the past to reduce their rents. And interestingly, the company law reform group that was looking at the whole summary rescue process, they actually didn't in the end make any recommendations on this point. It looks like from the report that there were diverging views on the point. Some members considered the matter to be too complex to be dealt with in a simplified process aimed at smaller companies, and others considered that it should be available where it was clearly necessary to ensure the survival of the company. So the report didn't really reach any conclusion on the issue, but obviously, and for good reason, various lobby groups have really pushed the fact that to omit this, something that is available in examinerships and has been widely used in examinerships, and to omit including a similar mechanism in the summary rescue process for smaller companies would mean that many businesses that otherwise might be able to be made viable would fail. And based on what the minister has said recently, I do think it looks like there will be a provision made for repudiation of leases in the new legislation. But it does look like that if that is required, that it will require court intervention. But the experience of examinership, I would say, shows that what often happens is that the very fact that there is a mechanism which at least can be repudiated means that it's more likely that landlords will kind of engage and negotiate more favorable terms rather than lose a tenant. So just by having a process encourages engagement by landlords. So okay. I think
on balance, as an insolvency and restructuring lawyer, you think the SCAR process is a good development, it's a good initiative?
I think that it definitely is. I think it's something that's going to be essential, when it comes to getting the economy back moving again and back on track after everything opens up. There's lots of these small businesses that are vulnerable but potentially viable, and they're going to need not just financial, but also structural supports if they're going to survive into the future. So the requirement to discharge legacy liabilities, and then at the same time fund investment into working capital that will be required when the economy reopens, will put a huge strain on lots of these companies, and a lot of them will have to consider restructuring options. And I think that this is going to be a really kind of valuable new tool for those companies.
Great, thanks, Julie. Just to broaden out the discussion, I'm going to bring in Fergal O'Brien, who's the Director of Lobbying and Influence at IBEC. Fergal, first of all, I was wondering what measures and supports and policies do you think are needed for businesses, both large and small, particularly small in the case of this discussion, once the COVID-19 supports are withdrawn?
Yeah, thanks, Michael, and thanks for the opportunity to join you this afternoon. I think we're going back to a really interesting economy, and I can talk a little bit about what we think we'll see on the demand side over the next while in a moment. We've had a unique opportunity over the last year because, again, the Irish economy has been a standout. We've continued to grow right through this crisis. So again, we've been the only economy in Europe that's been able to do that, which has meant we've had the resources to help those businesses and those sectors that have been most impacted. So we've really had this kind of K-shape. We've had lots of businesses in the economy doing really well and creating lots of tax revenue. We've had other businesses really needing a lot of support. So I think we're going back to a very positive business environment, but it's going to be a difficult enough transition. And when you look at that map that Neil put up there in terms of the supports, there's probably three I'd point to that I think are going to be really, really important in the context of the transition, and ensuring that we preserve as many businesses and as many jobs as possible. I think the first on the income side, the wage supports, both in terms of the wage subsidy, the employer wage subsidy, and the PUP payments, they've been incredibly important in terms of helping both businesses and employees. So we need to manage their transition, I think, in a very kind of careful way. The ministers tell us we're not going to have a cliff edge. Unfortunately, the employer wage subsidy already has a kind of an inbuilt kind of cliff edge of the 70% turnover threshold, right? So I think that needs to be graduated, and it's really important that we don't have kind of unintended consequences here with firms actually not wanting to get back to full tilt because they're going to fall out of the wage supports. So I think we need to graduate that up towards probably an 85% turnover threshold. That's absolutely crucial. And then on the other side of the income supports, on the PUP, we need to have an incentive for workers to go back. And we've made some adjustments to the PUP for self-employed people over the last while to allow them to earn money and still keep the PUP. So as companies are reopening, and if they have only reduced hours available, it's really important that that incentive is there for employees to take up even those reduced hours initially, so that again we'd have some flexibility in the PUP. I think the other really important element is going to be the debt issues. And again, Neil mentioned that the importance of the revenue and the tax warehousing through this has been absolutely central for so many companies. And the timing of bringing those liabilities back into the business, and in terms of pressure on cash flow for those businesses, the state has a massive role to play. So at the very least, we need to be looking at a really extended period of time before the state comes knocking on the door, in both from a revenue perspective and in terms of commercial rates. I think they're the two really big areas where the state's going to be looking at outstanding liabilities and supporting on that cash flow going forward. So I think they're probably the crucial elements in terms of the transition. But if we get that transition right in terms of supports, we can ease these down. And we can do this right towards the end of the year, I think, is probably what's going to be needed. And then hopefully we're going to see the demand side in a much stronger position.
Okay, and you mentioned the demand side. Do you see that as a potential risk, if you like, or even an opportunity? We discussed the other day how you see that demand is going to come back like a fire hose, if you like.
It is back. Very different to other recessions, and when we're either in recessions or coming out of recessions, we always look at the kind of the rescue restructuring kind of tools that we're going to need. And that's why I think the new proposals are so important this time, because I think demand's going to come back so strong, Michael, right? If you look over the course of the crisis, we've just put the equivalent of an SSIA, right? That took us 4 years to do back in the day. We've done that in a year in terms of savings for consumers and households, right? So we're up to almost 18 billion excess savings, right? People haven't been able to spend the money, right? And, look, obviously lots of people have suffered during the pandemic. the vast majority of people, and this again is evidenced by the income tax receipts just recently, like we're up 6 or 7% on where we were 2 years ago in income tax receipts. So there's been lots of income, lots of savings, and on the demand side, I think we're actually going to go gangbusters. But you know, we talk about kind of the letters of shape of the economy. We've been in a K over the last while. There could be a bit of a W in that demand could come back really, really strong initially because there's going to be so much pent up demand. Then we could hit a winter season for some of the hospitality and related sectors, and we could be in some difficulties again. So we're just going to have to take some time before this kind of levels out.
Okay.
But demand will come back really, really strongly. The pressure will be on the supply side, I think.
And what kind of implications does that have directly on businesses, you know, ordinary businesses, do you think?
Well, I think that the supply side pressures are going to be interesting. There's an awful lot of inflation and cost pressures coming back into business. We're seeing it in terms of global supply chains, commodities. We're going to see it in labour, actually. I think we're going to be looking at a very tight labour market very, very quickly, particularly if there's some inflation coming back in. And I think the challenge for business is not going to be getting the customers back and getting the demand back. It's going to be getting profitability back into the business and getting the margins back in. Because unfortunately, in a lot of areas, I think we're going to have much higher cost burdens into a lot of organizations. So again, we're just going to need all of the tools to make sure that businesses are fit for purpose, support them with restructuring where it's going to be needed, because there's going to be great opportunities if we can get the business models right and fit for what the future opportunity is going to be, I think.
Okay, that's great. Thank you, Fergal. Adrian Cummins, you're the CEO of the Restaurants Association of Ireland. Obviously, a sector very much involved in the whole COVID restrictions and the effect of that. I was wondering, what are your members expecting from, how are they preparing for the post-pandemic economy?
Thank you, Michael. So just to put it into context, when you look at the hospitality sector, you need to, and I know the audience are nearly 200 accountants here. So our industry has closed 429 days since the 15th of March last year until today. Some businesses traded for a maximum of 64 days. So they've built up a huge amount of legacy debt, and legacy debt in the shape of VAT payments that they may have owed to the revenue from 2019 or early 2020 for the first 2 months. Obviously, if they didn't get a deal with their landlord, and 80% of restaurants are rented, they've built up 429 days of rent due to the landlords. And then they have money still due to suppliers prior to 15th of March last year, or suppliers that they used while they were open for the 64 days. So when you put all that together, you're in a perfect storm for our sector, and the summary rescue program can come fast enough for us because it is fit for purpose for us. It's not perfect, but we're getting there. And there's a number of different actors and players that need to be that needs to, let's say, step up to the plate. So the first one, most important one, that any business owner, SME owner will say, revenue needs to be part of this. If revenue are not part of the solution, this will fail. That's the first point. The second point is with regard to the landlords. If landlords aren't part of the solution here, it'll fail. So they're the two most important components in how the businesses will restructure, and businesses will be saved and jobs will be saved also. Moving forward, Michael, as we start to reopen, and we will reopen, we'll either open fully in July, hotels will open in the beginning of June. And Fergal is 100% correct. There is a pent-up demand, but there's a pent-up demand at initially to get out and about, eat in restaurants, go on holidays. But people will want to travel outside the country once international travel comes. And that disposable spend could go outside the country, or could go into other sectors that are doing extremely well during the pandemic. But we want to try and capture as much of that as possible. And we will have extreme pressures around labour supply. We can see that already. 25% of our workforce are gone to other sectors. They're gone to the retail industry, healthcare, gone to the public sector as well. So you will see inflation. Most certainly you will see inflation. And you will also see, and I want to be very, very clear on this, you are going to see a substantial number of casualties in our industry. And because the reason being is our industry work off very tight margins. And when you have social distancing as part of the new norm, and you have to have a 25% reduction in your capacity within your business or your restaurant or hotel or whatever it is, that affects the whole business model. And you either do two things. You either inflate your pricing structure to counteract your loss in space as such, or your shop front. So it's not going to be as easy as that, but we are going to see, and I said this last year, and I probably got shot down for it, but I said that about every second restaurant could go to the wall. I still think they could. That's why this summary rescue package has to come into existence as quickly as possible, and very important that the revenue are part of this solution, because if they're not, it'll fail.
Yeah, but just on that point, and it's kind of related, we had a comment from one of the participants today that unless SCARP mirrors examinership, it's not going to be fit for purpose. I think it's the best way to say it. Would you? I think that includes the issue about what Neil calls state creditors, and particularly the revenue being involved. But obviously there's a risk of moral hazard there as well. But it's clearly important for you that the revenue are included in SCARP as a creditor. Yeah.
100%, Michael, and in tandem to the summary rescue package, it's very important that the state supports continue until March of next year. Why they need to stay in place until March of next year is that we need to get our tourism economy back up and running.
Right.
Because when we open, as night follows day, when we reopen in June and July, the entire East Coast will move to the West Coast, and Dublin will be a ghost town. And every business owner can foresee this already. We had it last summer when the staycation season kicked off. And Dublin depends on connectivity for the corporate market, from US clients coming in, European clients coming in, and we don't have a tourism industry yet because we don't have international travel. That will come, but we have to reboot our international tourism products for Ireland. We've lost nearly 50% of our connectivity routes into Ireland. We have to regrow those. And it's going to take us until next year. So it's very important that the government keep in place those support package and measures, and have it sector specific for the industry, for the sectors that require it most.
And in fairness, the government have performed well in devising specific supports and packages for the pandemic crisis, but it's the post-pandemic crisis we're discussing now. So it would be useful to continue that form of thinking, I think. So thank you, Adrian, for that. It was very insightful. It was good to hear about your experiences as well in that sector. I'm just going to bring in Julie again, Julie Murphy O'Connor. Julie, if you were advising a client and they're weighing up use of either the examinership process or the new summary rescue process, or SCARP as it's being referred to, what factors would you advise them to consider in choosing between the two?
Well, look, we haven't obviously seen the draft legislation for SCARP yet, but it does look like, from what we've been told, that there will be very little that can't be achieved in the SCARP process over an examinership. And in fact, it probably has more flexibility in that you don't necessarily have to go into court for lots of the things that you get in examinership. But if you do need those things, you can go into court, but the costs aren't there from the get-go. They're kind of add-ons as and when required, which does make it more flexible. It also has the added advantage of being able to potentially cram down things like revenue debts and rates. And one thing I do agree with Neil and Desi on this is that it could be an issue in terms of the shorter time frame for a SCARP process. So you have a shorter period within which to complete the process than you would have within an examinership, but I think with adequate preparation and pre-planning, in most cases, that should be achievable.
Okay. Oh, great. And you know, you'd agree that the breathing space afforded by court protection or protection per se is very important for business owners at this time. And you know, how would you advise them to use that time? Whether it's
so the thing with SCARP is that you don't automatically get the court protection. I think the idea is that if you think you're going to need court protection, you'll have to apply to court for that protection.
Okay.
However, it is possible to get it if you need it. So that's kind of an aspect of it being a bit more flexible than the examinership process. And of course, there'd be many restructuring cases for small companies where you won't necessarily need the court protection, especially if you have good stakeholder engagement and you know, good relationship with creditors, which a lot of companies would have.
Okay.
And you know, a lot of companies will have creditors that will work with them on the restructuring, because the premise of all of this, just like in an examinership, is that creditors through the rescue process are going to do better than if the company went into liquidation. So it's in theory, at least in their interests, to work with the company
Yes.
towards a scheme.
Okay, thanks, Julie. I'm just going to bring in my colleague, Dee Moran, who's a professional accountancy lead with Chartered Accountants Ireland and works with the Insolvency Committee of the CCABI. Dee, can you tell us about the views of the committee on developing the new corporate recovery process, and give us some information about information and services available from Chartered Accountants Ireland, please?
Sure, I certainly can, Michael. Many thanks and good afternoon to everybody. The Consultative Committee of Accountancy Bodies, or CCABI, have an Insolvency Committee, and they have been looking at this over the last number of months. And in fact, one of the committee members was actually working with the CLRG on the process. The committee is very much in favour of the proposed new process, and it agrees that it would be a really good option for smaller companies. And like everybody else, I think, you know, one of the main concerns that was raised at a recent meeting is the fact that the revenue commissioners could opt out of the process. Now, obviously, we haven't seen the finer detail on this yet, so I guess we'll just have to wait and see. But you know, I think that would be all for the entire process. In relation to Chartered Accountants Ireland, we have been trying to assist members, I guess, since the beginning of the pandemic, and we lobbied on behalf of members in a number of areas, including extensions to CRO deadlines and in the area of virtual meetings. And particularly, we lobbied on the fact that, you know, for the creditors' meetings to be conducted wholly or partly by the use of electronic communications technology, and we will continue to work on that. We've also issued a number of guidance documents which hopefully have been useful to members, including a piece on the going concern consideration for members preparing or auditing financial statements in the context of COVID-19. And I think that this is still very relevant today for anybody who is reviewing going concern. And we also issue guidance on accounting for government grants under FRS 102, because I know there have been a lot of questions about how to account and the accounting treatment for the government supports available. These are both available on the COVID-19 hub on the Institute website, which if members haven't looked at it, I would urge you to do so, because there is a lot of guidance there which may be useful for you. We have also recently set up a technical hub on the Institute website, and this has a wealth of information, and it has, particularly in the areas of auditing, financial reporting and insolvency. The insolvency pages, which is probably most relevant to this, contains technical guidelines or technical guidance on receiverships, liquidations, examinerships, and we are currently reviewing and updating these as appropriate. So I would encourage everybody to have a look at the technical website or the technical hub on the website if you haven't had a chance to do so. We just added a Q&A section on insolvency, which may answer some of the questions that you have. And we will endeavour to continue to support you with updates and guidance as we move forward on this.
That's brilliant, Dee. Thank you very much. Great promotional job there, dare I say. And finally, I'm just going to ask the final question back to Neil Hughes, by way of summing up the discussion, really. Neil, we've heard a lot today from Fergal about expected strong demand in the post-pandemic economy and the immediate challenges that will present businesses. What do you see are the opportunities in this situation presented by the requirement, for example, to change business models?
Yeah, Michael, there's been a huge, I suppose, expression of innovation in the last 12 months. You know, we've seen new ideas, we've seen creativity from businesses because they literally had to find new business models. And that, I think, is going to stand to us going forward. As I said during the initial remarks I made, there has been a new focus on efficiency, and people have found efficiencies in business, which they just didn't know were there, frankly. And that might be a permanent arrangement. And I think there's a resilience which we've shown, which I think Fergal has talked about there in terms of some of the economic indicators, which have been fantastic to see. And by the way, I think it's so valuable for us today. We are so lucky to hear from the actual members that are struggling, you know, in Adrian's organization, for example, to hear directly from Fergal's insight and to hear about the clients that Julie is speaking to. You know, I mean, I think we're just really lucky as an institute today to get that sort of insight from everyone. There's been quite a lot of talk as well, Michael, and maybe we should reference this conversation about state creditors and about the revenue and about the hugely important role they have to play. I think it's important we keep in mind revenue in any scheme, they have preferential status. You know, an examiner or a restructuring professional will set out normally with a view to trying to maximize the return to the state creditors. So, you know, this isn't some sort of a race to the bottom in terms of putting schemes together. Revenue have a preferential status, and that has to be respected. They have to be treated at least as well as they would in a winding up scenario, for example. But at the same time, they are the common denominator. And it is going to be really interesting to see how this plays out in terms of the schemes that are going to be put together under the new summary rescue process, which it could be a matter of weeks. You know, I understand that process could be in now before the summer recess. I think, as Adrian said, it can't come in soon enough for a lot of members. And Michael, I would say, you know, we've just maybe to finish up very early on in the pandemic, I'm not sure if they're members of Adrian's organization, but we had a creditors meeting of a award-winning business in Wexford. And unfortunately, they just figured they could not continue. And, you know, we'd met the people before because we had celebrated with them at the 2015 Wexford Business Award. They happened to be sitting beside us. And we celebrated together that night. And so it was really kind of a sad moment for us as a firm that we were speaking to them about hosting a creditors meeting. But anyway, to cut a long story short, to see the devastation that they were in at that time during the creditors meeting, the tears that they shed, because the business owner just broke down. He couldn't actually get to the end of the creditors meeting. I just said, look, this is terrifying. If we cannot, as a society, protect these sorts of SME businesses, and just to see the despair that people have been in, and that Adrian speaks to, for example, all the time, and I'm sure a lot of Fergal's members in the same boat. I think there's an obligation on us, there's an onus on us to try and make this work, to avoid that sort of devastation. And by the way, Michael, the RTE cameras are not going to be there to show that. You know, I mean, nobody in that situation, those people vulnerable like that, they don't want to go on radio to tell their story. So it's really important that we do speak about this in an open sort of a way, a transparent way, so that we can get it right, and we can get it right for those business owners that deserve a second.
And what are the typical things you would say to a business owner with a distressed business? What are the...
I say to them, please tell me everything good about your business. Tell me, why did you go into business in the first place? We'll talk about the creditors in a minute. We'll talk about the revenue arrears. We'll talk about the warehousing, etc. But can you just tell me about the business? Tell me all of the good things that made you go in. Like, what was it that brought a crackle of energy into that business? Tell me about the team, about the expertise of the team. Tell me about the customer service that you focus on. You try to get them into a recovery mindset Because if people have given up, there's no point.
So they believe, in other words, they
believe it. They just recapture those reasons that they went in the first place, and it tends to work, Michael. That's what we found in Baker Tilly. We found if you focus on those positives, well, then you can try and get the best result for the state creditors and every other creditor.
Yeah.
Because a going concern solution is inevitably better than the winding up, than the crash. Like, that's what we are very proud to try and avoid, and that's why we've been involved in a couple of hundred examinership cases in the last few years. It's
very good summing up about this whole last hour has been about, which is recovery rather than winding up, as you say. So we have a few questions from our participants, and encourage if anybody else wants to send in questions, as I say, if you could use the Q&A feature on Zoom. The first question was from participants saying, what schemes are available to refinance? My reading of most schemes is that they cannot be used to refinance or restructure existing debt. Does that?
Well, Michael, I covered a little bit of that in the initial comment, which is, some of the, for example, the credit guarantee scheme from government, whereby some businesses are looking to refinance. And there are some rules around that. But one thing I would mention in terms of schemes, people need to be aware of what's happening in terms of the exit of Ulster Bank. And for example, the potential sale of the book, the Ulster Bank book, which we understand might end up with AIB. But what we're seeing also is that Permanent TSB now have a number of different options to bring themselves, I suppose, to a greater distribution capacity than there would have been previously. And for example, the sort of joint venture they have now with Bibi, where they're going in terms of both property debt and working capital debt. That'd be one example. But I think it's really interesting just to see what's happening with some of those providers as they start to come together. Those are schemes in themselves. I mean, government guaranteed schemes, but there are other sort of schemes being put together and partnerships within the economy, which we need to keep an eye on. So that's something really to try and stay close to. As advisors, we need to be alive to all that.
Okay, so the importance of finance, particularly for working capital, as you say. Another question is how will SCARP deal with the VAT credit notes given by creditors when their debts are written down? The debts will only be written off once the creditors accept the scheme.
A real technical question.
Technical question, yeah.
There's always going to be one or two.
It is the Institute, after all, Neil.
Well, just Desi might be able to help me with this as well, but there is specifics in terms of, it's called Section 62A of the VAT legislation, in terms of the VAT write back. Revenue typically will look to make sure that they claw back any of the write-offs in relation to VAT. So okay, that's going to be a case-by-case basis, Michael. I'm not sure we can do a catch-all answer in relation to that scheme, because it depends on what level of dividend is applicable to the different classes of creditors, and that will govern then as to how the revenue. But there has been a change in the last 2 or 3 years whereby revenue would be looking to make sure that they don't suffer a sort of a double whammy write-off, and that, in fairness to them, that they're protecting their own position in relation to that.
Okay.
The mechanism is there, Neil. I think it's the contingent preferential claim that's in an examinership. So the SCARP should mirror that. I don't anticipate it to be any different.
I'd say it'll be the exact same. I'd say a lot of the SCARP will mirror the schemes of examinership and the methodology that is applied, because there's so much precedent. There's so many examinership precedents there.
Okay, thank you. Further question was, what role does the panel see for invoice financing playing in supporting SMEs in recovery, and as government supports are eased off? That's
well, maybe just Fergal maybe could come in terms of the different types of working capital finance that's out there, and the importance maybe of different providers in the marketplace, different banks in the marketplace. I don't know if IBEC has a view in terms of the importance of more and more banking providers.
Yeah, thanks, Neil. Thanks, Michael. I think one of the things we are going to have to see over the next while is actually a bigger role for the state. So we're going to have to learn what worked well during this crisis. Obviously, in the run up to Brexit, we've been putting a lot of measures and tools in place as well. What we've found, where we've seen biggest demand, is where we can get longer term loans, longer term credit, right? Particularly going out 7-10 years. That's where we're getting really strong demand. And where we're getting that at good competitive cost. because unfortunately, one of the features of the financial crisis of over a decade ago and everything that's happened since in the Irish banking market is that there is quite a premium from regulatory costs and everything else on credit in the Irish market. So this is a big competitiveness issues, because unfortunately an Irish SME now is going to have to pay more than our competitors across most of Europe. So the state's going to have a bigger role to play. And we have learned in the last year or two the type of instrument that we see particular demand for. So if we can get medium to long term term product, reasonable cost, we will see that demand coming back, because there's actually been very weak demand for credit over the last year.
Okay, and a related question to that, Fergal, is from another member of our audience, is asked, can you see the development of the peer-to-peer crowdfunding market, finance market in Ireland? You know, and could the state play a role in developing that, or is that just too commercial a sector?
Well, I suppose regulatory certainty is probably going to be the key role for the state and the central bank, and kind of appropriate kind of flexibility and supporting agility in terms of what the private sector is going to bring. But I think there's great opportunity to see lots of new product and innovation in this space, because again, you know, go back over a decade ago, we were by far the most banking reliant economy in Europe. We need to continue to evolve all of the kind of credit tools and business financing tools, equity, debt, and right across the mix, because we were far too reliant on the traditional bank financing. So let's bring that innovation, and the state can give the certainty around the regulation.
And do you think there's appetite for that on the state's part to get involved in finance?
I think you dropped out, Michael, for a second.
Okay. I wasn't sure it was my link. There's just one last question here, which is quite technical, I think, and again,
legal, maybe.
Or legal. Can you see it there? Yeah.
Julie, Michael, I'd say. I'm just
because you are one expert to another. Perhaps you could interpret that question, Neil, for Julie.
Yeah, it's a contractual question. I don't know if you can see it there, Julie, but it says in any arrangement, ongoing support of customers is required, as well as suppliers. Often contracts have termination clauses in the event of entering an arrangement, and I presume that means like a scheme of arrangement or an insolvency. Is this another deterrent? And I presume the question really is this another deterrent to having a successful restructuring scheme? But I mean, I know, Julie, for example, some leases would have, they would terminate on liquidation, some receivership, some even examinership. None will mention entering into a SCARP, I wouldn't imagine, unless you're drafting.
No, but yeah, they won't mention SCARF, but a lot of them are quite broadly drafted at the same time. So they will refer maybe in broader terms to a scheme of arrangement, which would, I think, apply to a SCARF as it would to an examinership, or to another more, some of the other schemes that are available under the Companies Acts. So it's not unusual for them to be for there to be termination clauses in lots of contracts that we regularly in other insolvency processes as well, and we have different insolvency procedures. Can you hear me there? It says my connection is unstable, but
we can. There was just a little bit of a blip there, Julie.
Stayed for about 3 seconds. That's all. You're back.
So I was just saying it's something that we have to deal with in all of the different insolvency procedures. Is this issue about termination clauses in contracts? Now, obviously, you can't make somebody trade with you throughout a process. So the moratorium in an examinership, and will be the same in a SCARP if one is applied for, can prevent certain positive actions enforcement type actions being taken by creditors, but you can't force somebody to supply you throughout a process. So what happens in practice, and you'll know this obviously very well, Neil, from all the examinerships that you've been involved in, but often what a creditor or a supplier will insist on is cash on delivery, for example, during the time that the process takes, or for some sort of kind of protection for ongoing contractual payments.
Yeah.
While that process is in train.
And it'll be interesting, Julie, to see if there's going to be like a Section 529 cert, the old Section 10 certs, in a SCARF, to give that extra bit of comfort. So that's going to be an interesting.
Yeah, exactly.
Okay, Julie,
Yeah.
thanks very much for that answer. I think that's the last question we'll take this afternoon. So I think before teenagers and kids start to log on and Wi-Fi gremlins kick in, it's about that time of the afternoon. I think we'll sign off. I'll just say my thank yous. Thank you to everyone who attended today. It was great to see that number of participants. We hope you found it informative and useful. I'm very grateful to our panelists for their contributions today. Adrian Cummins, Dee Moran, Julie Murphy-O'Connor, Fergal O'Brien, Desi Morrow, and Neil Hughes, of course. Thank you also to Chris O'Donoghue and Sasha Brinkley for the support on the event production. And finally, remember that Neil's book, A Practical Guide to Examinership, is available to buy from the Institute website. From our bookstore. As Neil said, we'll make the slides available from today. If you want to email publishing@charteredaccountants.ie, we can send them to you, or you can download them from the Chartered Accountants website. But thank you very much for your attendance today. Good afternoon.
Thanks, Michael.
Thanks. Bye-bye.
Thank you. Bye-bye.